disruption is what benefits our industry. And the downward pressure that we've seen on self-storage the last couple of years is a lack of mobility and a lack of disruption, right? The single family home market is not frozen, but it's very anemic, right? People can't sell their houses. Buyers can't afford to buy the houses. People stop moving as much, right?
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Hey, what actually drives returns in self-storage, and why do so many operators miss it? In this episode of Path to Passive, we sit down with Jacob Vanderslice, co-founder and principal at VanWest Partners, for a practical operator-level look at how self-storage businesses are really run. We break down how VanWest uses real-time data and revenue management to grow NOI, or net operating income. And we discuss the decision that Jacob and his team had to move away from REIT, property management, to fully self-operations, and how small operational decisions compound into meaningful performance differences over a time. If you're listening to this and you're a tech professional, I'm sure you can appreciate the perspective of operational excellence. We also cover real risk investors should be watching for in self-storage today, especially in perspectives of supply, market level dynamics, and something that I like the way it's put, which is American mobility, or really the customers of self-storage, or one customer set of self-storage. Why discipline, responsiveness, and operational excellence matter more than perfect models. So, to learn more about self-storage and how experienced operators think about running these businesses, make sure to check out Jacob and his team at VanWest Partners. And of course, for more operator-level insights, please subscribe to the REIT Capital newsletter for bi-weekly insights and lessons pulled directly from episodes just like this. Take notes and enjoy. Mr. Jacob Vanderslice, man, thank you for being here. Thanks for coming on the show, sharing your experience with the audience. Of course, this is Path to Passive Real Estate Investing for tech professionals. And so, you've got a pretty cool background. I like, we'll get into that. But, we were just talking before we started today, and one of the things that I had heard doing some research and you getting to know you some more is, how do you say your first job is to be a father of two, and then you're a real estate investor second. I thought that was pretty cool. I'd love for you to tell us a little bit about, how you got into real estate and your family life, and how, you support thinking about being life first and then real estate investor second.
Well, the first answer is I have a wife with a big W-2. So there's the easy one. I haven't had a W-2 since 2006, and there's some years I miss it, especially the last couple of years. But seeking balance is kind of a never-ending quest between family and work, especially with little guys. Our boys are 6 and 7. School activities, after school activities, getting home to take them places they need to go to. And I think as a parent and an entrepreneur, you're turned on 100% of the time, right? But the end goal of all this is to create stability and wealth, and pass along something to them that is meaningful, that they can go out and be responsible with. And along the way, not missing soccer practice and their karate belt test, right? It's a challenging balance, and something that I may never find perfectly balanced, but I'm working on it.
We'll definitely get into. Actually, I really want to get more into the real estate, or I want to get more into that. But of course, we're here to talk real estate as well. But let me ask, and then we'll make that pivot. Do you have any guiding principles, or what is your mental models, or just how do you make those decisions about prioritizing, like you said, the karate tests and anything else, or is it just pretty cut and dry?
Tactically, it's calendar blocking. Easier said than done, but it's just calendaring everything. If it doesn't exist on my calendar, it doesn't happen. I use, not to get nerdy on you, but I will anyway. Apple recently integrated their reminders software, their reminders app, with their calendar app, and I'm kind of a Mac. I like Macs. and I've got something like 4,500 completed reminders on my reminders app. So just time balancing, blocking it to do the things you need to, blocking time for reflection, which I have very little of, and kind of strategic thinking, but also blocking time for calls with our investors, for again being home with soccer practice. Calendar blocking tactically, philosophically, I don't have much to offer there on how we do it. It's just the mechanics of the calendar.
Yeah. Gotcha. But, well, you didn't always start in real estate either. You were in fire department, right?
Yeah, I mean, I was a long time ago, but I mean, by and large, for almost half my life now, I've been a full-time real estate entrepreneur. I was in the fire service many years ago, and I loved it, but I always wanted to be in real estate. I started doing some deals on my days off on the side, and quit my fire job, and I've been gainfully unemployed ever since, I guess, 2006 now. We got started doing residential fix and flips. We did a bunch of them all over the country. That was our main line of business for about 10 years. And around 13, 14, we got into commercial real estate, kind of adaptive reuse retail projects. We did some town developments, some multifamily, industrial. We really covered a lot of the food groups out there in real estate. There are to cover. There's not really an asset class, I don't think, that we haven't touched before, even mobile home parks.
Nice.
And then we got in the storage business in 2015. And at the time, it wasn't really a strategic pivot. It was more, let's try a deal type out that we haven't done before and see how it goes. And we also wanted to shift our thinking a little bit more to being more long-term cash flow investors versus being overly transactional, meaning buying, making better, selling, and doing it over and over again. We wanted to buy, make better, enjoy the cash flow, eventually monetize that value creation. But we thought storage was a good vehicle to do that with. So we did our first project. It was a development deal here in Denver. So kind of jumped in the deep end head first, and did one after that. And over time, we evolved to being pretty much exclusively a self-storage owner-operator. Today, we have 41 facilities, about 21,000 units, about 3.5 million square feet. And most of the deals we've targeted, we've done some development along the way, but most of our acquisition targets have just been value-add deals that we identify that are undermanaged, below market rents, above market expenses, and we endeavor to grow NOI over time.
So it's interesting because, we hear a lot about like multifamily value add, and for most people that's pretty straightforward. Like you went over that quickly of the different food groups and talking about the different asset classes, but you really started out as doing, like going to the auctions, picking up these homes, fixing them up and selling them, right? And then from that transactional, but over to the cash flowing part to it. And you mentioned here self-storage is now a primary business. But you said, if I heard you correctly, you were talking about value add self-storage. Is that right?
Yeah. So when I talk about value add, I mean, thematically, using the term value add on a storage facility, it could transcend into the same components in using a value add term or strategy on a multifamily building. And when we talk about value add, most of that, some of it comes from capital improvements, like an apartment building. You might see a sponsor's model that says we're going to put 25 grand a unit in, right? New appliances, new countertops, flooring, paint. And then we're going to raise rents from $1,000 a month to $1,200 a month over some amount of time.
Yep.
So we're doing the same thing in self-storage. We're not necessarily, obviously putting carpet and paint into a storage unit, but we're putting a new roof on. We're rebranding the signage. We're updating the leasing office. And all of those capital improvements are an effort to increase your revenue and your NOI over time. And if you talk to any real estate operator, regardless of whether they're a developer, they're buying existing buildings, self-storage, multifamily, industrial, I think the common goal we all have is growing NOI, right? And commercial real estate, residential real estate, depending on the product type, trades on the multiple of NOI, otherwise known as the cap rate. And that's where the rubber hits the road, growing NOI over time and then monetizing that NOI growth at a market clearing cap rate. And the delta between your cap rate and the sale cap rate is where you make a lot of your money. So we're doing the same stuff in self-storage, at least trying to.
Yeah. And from what I understand, that's at least it's very data driven. So that would get you a lot of insights as well, right? Like talk to me about what you're doing on, you talk about being Mac nerd and tech nerd stuff. Like, come on, you're on the podcast for this, Jacob. So definitely, especially talking data. So, how are you, as much as you want to share, like get the data, how do you utilize it? How do you get that to make business decisions for the self-storage and real estate in general?
Yeah, one of the unique aspects about self storage is how dynamic the revenue is. So all of the leases are month to month.
Mm.
So revenue management is a key component to creating value and protecting downside. And revenue management simply means you're regularly and consistently marking your rents to market. And if you're not filling up like you want to, you drop your rents. And if you're maybe fuller than you should be, believe it or not, self storage, if you're at 98% occupancy, you're not a hero. It means your rents are too low. So you want to increase rents there, drive occupancy back down a little bit. And how do we monitor rents? Well, we do it a lot of different ways, but putting kind of a software engineer spin. My partner is a software engineer by training. Grew up with them, high school, college. He joined me in 2008, and he's built a number of interesting platforms that we use to kind of understand the different data sets that are out there and apply them to our revenue management strategies. One of them we call Market Sentry, and it's a cute name for basically a scraping software. So he's had this going for about 10 years now. And several times a day, the software will crawl the asking rates on thousands of other operators' websites.
Nice.
And sometimes they'll kind of redo, I'm not a software guy really, so if I say something stupid, bear with me, but they might redo their firewall to kind of prevent somebody from doing that. So we have to find a workaround to that operator's website to kind of get back in. But it scrapes all of these street rates or asking rents from thousands of facilities around the country. And it puts this data into a database, and it saves it back to, I don't know, I think we have data going back to like 2016, maybe, when we kind of launched this. And you can look at the seasonality trends in a given market. So Milwaukee is going to have more pronounced peaks and troughs in the winter and summer than obviously the Florida Panhandle is, or Austin, where you are. So you can look at these trends and you can see how a given unit type, let's say you want to know what a 10 by 10 climate controlled elevator access unit is leasing for within 3 miles of our project in Southeast Denver. You can pull that report, go back in time to see what the trends are. You can see the impact of a new competitor coming online. So this really allows us to make a more informed acquisition decision by being able to normalize those historic rents. But then post-acquisition, it allows us to more efficiently manage our in-place revenue because we have a real-time data feed to our competitors' asking rates. Now, their asking rates are not necessarily what they're achieving. The last couple of years, more than ever, what's on the website is really not, it's very far away from what they're achieving. So the data integrity needs to be, interpolated and kind of thought through by a human. But nonetheless, it's a powerful tool, looking at a new deal, underwriting it accurately, but then also efficiently managing the revenue after.
Interesting. So that all that makes, a ton of sense. I'm curious, based on what you found, is it like, it's so asking, meaning what's out there posted on the website for the data that you're scraping versus what they actually achieve, the discrepancy there. Do you find that's like 10%, 20%? Because, that's kind of like, putting, an apartment, putting something out there posted just to make the comparison for the listeners too, right? Of them, someone posting that this is the rent, but, come in for the first, whatever, if they're running a special, there's concessions, or, it's the first 90 days, get a month off or something like that. So what do you end up finding is kind of the delta?
So the delta's changed a lot. So I guess if you could kind of pick a point in time, I would say early 2023, leading up to early 2023, the standard revenue management practice was, depending on the facility and the occupancy, the move-in concession was first month free, right? Or 50% off the first month. Then you pay market rent. Let's say the unit's worth $100 a month. So you move in, you pay $0 to $50 for the first month, and you pay $100 a month. If you're still there 9 or 10 months later, you'll see an increase of maybe 10 to 15%, right? Depending on the unit type, the location. And that revenue management practice was materially changed by the REITs who kind of led the charge in 2023. And what they started doing was that unit now that is kind of, so to speak, worth $100, they advertise that unit as being $50 on their website. And from the outside looking in, if you're purely looking at advertised rents, you might conclude that rents have gone down by half in that submarket, right? Which is not good. So what the other side of the coin is, though, what the REIT started doing, and we're slow learners, we eventually figured it out. We kind of followed suit. Is instead of that customer paying $50 for 9 or 10 months and seeing a 10 or 15% increase, that customer went from $50 to maybe $90 in 3 months.
Yeah.
And the jargon for that is called an existing customer rent increase, or ECRI. ECRI. So the theme has been on the revenue management side, a more material discount from market rents to get the customer in the door, and then a more rapid increase up to market rents in a shorter amount of time.
Right.
So that's why I mentioned before our scraping software, and it's giving us that data. That $50 unit is not really achieving $50. It's probably getting a lot more. At least it will get a lot more, depending on the operator.
Got it. That makes a ton of sense. That's it's probably a really interesting space, because any business, you're going to have, a lifetime value for a customer too, right? And by them dropping it much lower and then bringing it up, they end up are able to maintain that somewhere if they bringing up higher on further down in time, because they recoup their cost, right?
You've got the average duration of tenancy, but you've also got the cost of acquisition per customer, right? Yep. It's been a lot more expensive the last year as the market's kind of softened, because a lot of operators are fighting for a smaller piece of the pie, and many of the bigger ones are throwing a lot more money at it than we're willing to. So as we're looking at ECRIs, we're also trying to subjectively and objectively balance that, retaining that customer in that unit for as long as we can. And it's a tough line to walk, managing your occupancy with your revenue, right? And the two definitely correlate. But just because your occupancy is high doesn't mean your revenue is where you want it to be. And likewise, if your occupancy is lower, you might be achieving the revenue you targeted. So it's a balancing act on kind of when to push those ECRIs, how much. And we look at on the unit level, like a 10 by 10 by the front door, versus a 10 by 10 elevator ride to the third story is going to command a different price, right? Yeah. So those are all things we look at when we're making our decisions on, how much to push and how much to pull back.
Yeah, cool. I know we went down a rabbit hole on that one, so let's come up just a little bit from there. And you talked about starting and doing jumping into real estate on, we'll call it the time off, the time you weren't being in the fire department, and trying and working with these different projects and the different asset classes, and then ultimately staying focused on self-storage. Now, I'm really curious to get some insights from you along the way here, because I think these insights are really what switch on the lights for people. It's like kind of the aha moments. And the one that I think would be good for next year is where I'm going to go next year, which is you got more into self-storage, and of course, did the first project, the second project. Now, were you doing outsourcing any of the property management for those when you got the first ones, or did you immediately start managing and operating it right away?
Well, you teed that one up in the fairway there, for sure. When we first got in the business, we had some high net worth kind of JV partners that were doing these deals with us. And as bootstrappy and entrepreneurial as we are, we're like, we'll go manage these things. We can figure it out. We can operate real estate. They're like, no, we're not going to give the keys to the car to a rookie who's never, operated self-storage. So we said, fine. So we hired the REITs, and we were dazzled by their revenue management algorithms, their secret sauce marketing, their branding. And we didn't know. So we had the REITs manage our portfolio. And over time, as the honeymoon kind of wound down, we started to realize our interests are kind of misaligned in a lot of areas. And, again, big surprise, but third parties don't care about your deal as much as you do, right? Yeah. One big revenue stream in self-storage is tenant insurance. So it's like buying car rental insurance at the airport. You probably decline it because you got coverage on your auto policy, where a lot of people buy that. There's a lot of margin on that insurance policy. So it's a big revenue generator in self-storage. And depending on the REIT, they keep either all or most of the tenant insurance revenue. And so we're looking at our income statement thinking, man, this customer moves in, they get a free month of rent. The REIT gets prepaid tenant insurance premium, and the tenant's paying the same insurance premium along the way, regardless of how discounted their rent was. Then Operating expenses were kind of bloated. Marketing allocations were non-transparent. We couldn't necessarily prove that spending 30K on our site in whatever town was driving customer traffic to our facility. It was just kind of hit with a global an allocation based on the deals in that market.
Yep.
So we formed our own management company. We formed Clear Home Self Storage back in about 17, and we started managing all the deals we were buying on a go-forward basis. And then over time, we started taking the deals back from the REITs and then self-managing them. And as you can appreciate, and I'm sure the listeners, property management is a very painful, very low margin business. But controlling the operational platform, I think, is critical because that's where you're going to grow NOI or not grow NOI.
Definitely.
And we have almost 90 employees, and about 73 of those are in our property management company, our on-site teammates, regional managers, asset managers. I think that's why we've had some relatively decent performance the last 2 years, is because we kind of control that. And we're not smarter than the REITs by any means. We don't have better software. We don't have better technology. But the one differentiating factor, I think, is we pay a lot more attention because there are deals. We're going to fight for that HVAC invoice. We're going to rebid snow removal and landscaping contracts to save a couple grand. And doing those little tiny things that grow NOI over time generally can create exponential increases in value. So we did the REITs. They know what they're doing, but they don't care as much as we do. So that's why we self-manage.
Yeah, definitely. It's, no one cares as much about your money or your investors' money as you do. And,
Yes.
even above that, I mean, I wouldn't say above that, but, as much as that too, it's, but you can't get past operational excellence. I mean, massive starter there on my part. But the point being is you can't fool people about that, right? And
No,
so that is the
no.
differentiator too.
And that's a phrase we throw around a lot, just like, the quest to find a balance between family and work. Operational excellence will be a never-ending pursuit. We'll never get there, but we sure are trying.
Yeah, yeah. And so you mentioned a couple things there about working with the REITs and how there were not aligned interests. Was it mostly the not aligned interest about the caring and the details and those things that you walked through?
Yeah, I mean, a couple examples were, hey guys, we're 93% physically occupied on this facility. Let's push rents. They would push back and say, no, our algorithm says we should keep it here. It's going to be a more efficient path. The REITs will often manage, and I'm not, again, trying to disparage the REITs. They're a lot smarter than we are, believe me, but they'll often manage to occupancy a little bit more so than they will to revenue. Maybe that's changed a little bit in the last year. But just seeing fairly obvious low-hanging fruit and not being able to get them to kind of take action because it doesn't follow their playbook. Then obviously the tenant insurance, right? They, the deal generates revenue that's material. We don't get any of that, and they get all of it. That kind of felt like a misalignment to a degree too.
So it sounds like what you're referring to then is actually, you were talking about they cared more about the tenancy and looking at those numbers for the quote unquote, their algorithm and their playbook. And I think that's an interesting part too, especially in the context of talking about, operations and operational excellence and what the real drivers are, because just because you have, higher occupancy doesn't mean you're going to have higher revenue, as an example, right? And so which one is really being paid attention to, and not just, someone pointing to the computer to be like, look, metric goes higher, but more like what's best for the business as a business decision, right?
Yep, absolutely.
So the decision for the property management company, for Clear Home Self Storage, your property management arm, was to really have control, and that not only serves you as having more visibility and better visibility, but I think one of the other things, which I'm sure you can speak about as well, is something I've heard you mentioned before, is transparency isn't just value, it's our product. Investors trust us because they can see where every dollar is. And kind of using that as a springboard, the next part here, the next insight to walk through is, when you were doing the next projects that you had, did you do syndications or did you jump directly into funds? Because I know you have multiple funds out right now.
Yeah, I'll answer that question in a moment. You mentioned the word transparency, and most sponsors will say that's a core value. Whether they live and breathe that is always kind of TBD. But on the software front, another platform we have we call Clear Insight, and it's a custom built dashboard that has an API into our property management software. So any one of our investors can log in at any given time and see one of 25 different KPIs we use to measure the performance of our asset base: occupancy, revenue, delinquency rates, tenant insurance, and they can see a graph historically over time. So it's a real-time kind of feedback tool people can use to kind of check in, like, oh, what's going on with the facility in North Carolina right now. It's important that investors can see what's happening, if not on a real-time basis, very regularly, because they're trusting you to execute and deliver the returns you targeted, but more importantly, not lose their money.
Yep.
As far as the history of how we structured deals, we did a lot. We did like 8 or 9 deals, storage facilities, from when we started up until about 19. And those were all done in single asset syndications, but they were done with kind of a common capital base. So even though they were standalone entities, there was still a lot of overlap with investors. We did our first storage fund in 19, and we closed that in 20. And fund 2 was in 21. And then we launched fund 3 in 22. We closed that in 24. So most of our deals have been done in the context of one of our 3 closed-ended fund vehicles. And in 24, when we closed fund 3, we had thought about launching a 4th fund. But we were not and still are not seeing the deal flow to warrant launching a full new fund vehicle. But we were still seeing a handful of deals that we really loved. So starting in 24 through today, we've done single asset syndications. And there's benefits and detriments to funds and syndications. Funds, you're inherently a little more diversified. If there's a deal that's maybe underperforming, ideally it's balanced out by the other deals that are overperforming. But the problem with funds is, if you sell one deal and you put up a good return, the relative whole dollar distribution to investors is pretty nominal, because maybe you just sold 1 out of 15 and maybe it was a 2x and a 20 IRR. But that 100K investor only got a $10,000 distribution, right? Whereas in syndications, if you sell it and it works out, that liquidity event is much more material. The other upside of syndications is you can kind of pick and choose where you invest. Maybe a fund you're in, you don't want to buy in Illinois, and the fund manager will certainly listen to you, but you technically can't prevent them from buying a deal in Illinois because you don't like it there. Whereas syndications, you can kind of be more choosy on the submarkets you're in. Maybe you like Vegas, but you don't like Tequila, Georgia, right? Benefits and detriments to both, but for the last year and a half now, it's been single asset deals, and I suspect we'll be doing single asset deals for the foreseeable future, and until we see signs of deal flow improving, which we are definitely not as of yet.
Got it. Yeah, I was going to ask based on that logic. I mean, there's cases where the fund managers and the setup of it could always say that we acquire in these states, right? Or these specific locations. So it's definitely something that, investors just want to look at. But I totally agree with you too. It's like, it's up to the fund. They can do with what they want, and you only have so much control. I think that's your point, right?
Yep.
And so,
yep.
So it's an interesting point though, what you're making it here is that foreseeable future will be doing single asset syndications or single asset acquisitions, really, then because of the deal flow. So what's the, I'm not asking you to look into crystal ball, but I'm sure you have a thesis and some thoughts on this. Based on the deal flow then for self-storage, you think this is someplace you will continue to play for a while?
Yeah, and we'll always be a self-storage owner-operator. I could see us dusting off some other asset classes we've done over the years we haven't touched for a while, just kind of depending what the opportunity is. I consider myself a real estate entrepreneur that just happens to own a lot of self-storage. And,
right.
When and if it makes sense to kind of look elsewhere, we'll certainly consider that. But as far as the crystal ball goes, we can never predict the future, obviously. And one thing I like to say is our models are always wrong, right? Mm-hmm. The deal never goes exactly like the model says it will. But I would say, forward-looking assumptions and sentiments and just seeing tomorrow and seeing next year is more opaque than it's ever been. I think we've got just landmines of risk out there that we're only starting to see kind of material in some of the recent job numbers that came out. And I'm not saying it's a time to stop, but it's certainly a time to be increasingly cautious on whatever you're doing. Interest rate risk, economic risk, maybe political risk, you know, macro geographic risk potentially. It's a tough time to determine where to deploy capital right now and into what asset class and with who,
Sure.
which is why we haven't done much for the last couple of years.
Yeah. So it's it can be a big decision for many people, right? Making these investments, and even just looking at a portfolio asset allocation perspective. These are questions I always like to ask. You brought up risk and really thinking about the risk return, profile of something. So if someone is listening and they're looking at, okay, self storage does make sense to me. I understand it. Jacob, you and your team might have a deal that comes up, and they're interested in self storage. Where does self storage kind of fit in the asset allocation perspective? Because we've talked about just before we started recording as well that private credit is more and more popular now, but also from a perspective of boring, consistent, lower risk returns, right? And so there's, as an example of a place to be. Where do you think self storage kind of fits in here?
Well, a targeted return should obviously be a reflection of the subjective risk of that given investment, right? If
Yeah.
you're taking more risk, you should be getting paid with a higher return. And we have seen very few deals in recent history that meet our risk adjusted return requirements. So historically, and I'm a big history guy, but I think leaning on history as far as looking back at past economic downturns and trying to interpolate what's going to happen in the future, I think is more difficult to do than ever because of all the changes we've seen in the world, right? Access to information, AI, it's a vertical line these days. But with that being said, historically, self storage is relatively recession resistant and downside protected. And our industry benefits from American mobility. And whether that mobility is being caused by good or bad things, getting married, getting divorced, upsizing and downsizing your home, getting a better job or losing your job and having to go, wait tables to make ends meet, disruption is what benefits our industry. And the downward pressure that we've seen on self storage the last couple of years is a lack of mobility and a lack of disruption, right? The single family home market is not frozen, but it's very anemic, right? People can't sell their houses, buyers can't afford to buy the houses, people stop moving as much, right? Uh, People who maybe want to leave their job, they're making a pretty good income on, are too afraid to take the risk to leave to go replace their income because their buddy got laid off in their same role at the company they were looking at, right?
Right.
People are not moving as much. But the main risk, aside from macro factors like American mobility, the main risk in storage is supply. It's a 3 mile business. If you buy a deal in a given submarket and 5 facilities get built within 2 years after you buy yours, you're going to have real downward pressure on your rents and occupancies.
Mm.
Um, so, from a risk perspective and an allocation perspective, as people consider maybe looking at storage offerings with private operators to kind of diversify into. I think it's still a resilient asset class, but supply risk is something you should be looking at more than ever. I think nationally we've digested a lot of that supply shock that we saw coming out of the kind of the boom years out of COVID. But there's still a lot of facilities getting built because once you break ground, regardless of what the market's doing, you got to finish it, right? You can't just stop.
Right.
But I think it's I'm obviously very biased here, but I think it's a good asset class as far as blending that downside protection with quantifiable, reasonable, and achievable upside at the same time. And it's been around for a long time. Industry is still very disjointed. 70% of the facilities in the U.S. are owned by smaller operators.
Mm-hmm.
So no doubt there's been consolidation with private equity and REITs the last couple of years, but there are still just countless facilities out there that are owned by an airline pilot, right? You fell into it 20 years ago, it was 98% full, and there's some meat on the bone for some NOI growth there. So it's a good spot to be, but proceed with caution, just like anything these days.
Yeah, I think it's an interesting point because I'm sure you can agree with the idea of real estate being quote unquote local, right? It's like, is self-storage still a good asset class today? Yeah, of course. The business model works, but it has to make sense wherever those markets and sub-markets are, especially like you said, the customer base is a 3-mile business, right? And looking at whatever's happening in that market. So, where does the asset class of self-storage fit? Well, it depends on the market. Does the business model work? Yes. Look at where it is, look at the market. But you brought up an interesting point here too about, the types of customer base. And let me kind of pre-frame this, which is I've never had a self-storage. I totally see the value in it. I haven't invested one, would absolutely invest in self-storage. But I'm not your ideal customer. But you talked a little bit about that customer already, like the American mobility, the people who has stuff in storage. Can you add a little bit of color here, a little texture on who the types of customers are, so that if people listening are like,
Yeah.
self-storage makes sense, but
Sure. Of course, it varies from deal to deal, submarket to submarket. Like we just opened up a big development project in a very dense infill part of Southeast Denver, and our average unit size is very small. So a lot of our customers there are millennials who are storing like skis and mountain bikes and seasonal gear. They don't have room in their apartment for it. Other deals we have that are more suburban, we have a lot of 10 by 20 units, for example, larger unit sizes. And those customers tend to stay longer because they've got a lot of heavy stuff in there and it's hard to move it. About 20% of our customer base are using their unit for their small business. Maybe they're a beverage vendor. They stock vending machines with a truck. They keep all their gear and all their inventory in the storage unit. Contractors, plumbers, landscapers, people who just need some extra 200 square feet to keep their stuff in for their company. We have quite a few customers like that. But I mean, the demographics really range from deal to deal, ages, income levels. But somebody's always moving, and Americans have a lot of extra stuff they don't want to get rid of. And the psychology of this business is fascinating because people will spend $1,000 to store $500 worth of stuff, right? And it happens. I'm guilty of that too. We moved a tenant into our office building that we own. Had a bunch of stuff down there, family heirloom furniture, a dozen pairs of skis, and didn't want to deal with it. So I put it in a storage unit, and I told myself, I'm going to be out of here in 3 months, right? I'm just going to keep it in here for a bit. I'm going to donate some to Goodwill. I'm going to take some home. I was paying rent on that unit 15 months later. And I finally made the time. I just didn't have the time to get it out, right? I got to go over there on the weekend. Some of the stuff is heavy, so I need a buddy to help me move a table or whatever heavy dresser. 15 months, and over that time horizon, my rent went from $120 to like $330, and it was enough to annoy me on the monthly hit on my Amex, but it wasn't enough to put my lights out. Every month, I was like, I'm going to do something about it this month. Didn't. And rinse and repeat another year, and I finally did. So that is a very typical kind of self-storage customer story. You got to put this stuff somewhere. I don't want to deal with it, and it's just easier to let that money, incrementally bleed out of your bank account than to go find a place to put it.
Yeah, it's interesting, right? Talk about the psychology of it. It's like, it's okay. I've got other stuff to do, kind of thing.
Yeah. In the same vein, we made. I won't bore you with this story, but. We built a lot of our software internally, but our property management software, it's just too difficult to recreate that. So we pay third parties to basically rent their platform. And we got rid of our old storage management software and transitioned to a company called Cubby. And they've done great so far. They're kind of startup-y and more forward-leaning tech and capabilities and report pulling. But the downside to it was we couldn't transition our auto pay to the new platform. And when we reached out to our customers that were on auto pay, and we said, hey, sorry, we got to recollect your ACH information, your credit card, because we got a new platform, please fill out this form. That was a catalyst to remind them that they're paying maybe unnecessarily money on this unit they forgot about. And we had a ton of move outs. So we knew it was going to impact us, but we lost a lot of those auto pay customers because it was we poked the bear, right? It was a reminder they're dump trucking money on something they probably don't need to, and there was enough of a catalyst to kind of get them moving, just like I did, and get their stuff out of there. So Yeah, don't poke the bear if you can avoid it.
And also auto pay. Got it. Business
Yes,
lessons for sure.
yes. Auto pay is always nice. Although we enjoy, I hate to say it, I'm a dirty capitalist. We enjoy our late fees too. Some percentage of our customer base, pays on the 12th of every month when they pay their late fee. And late fees individually aren't much, but in aggregate, they add up to be fairly meaningful. So we prefer auto pay, obviously, but if our late payers pay consistently, as long as they pay, we're okay with a late fee too.
Yeah, yeah, totally. I'm curious. I wanna pivot to investors here, investors stories here in a second. But I'm curious. We talked about the typical kind of customer profile. I'm wondering, do you have any data or anything anecdotally about why people leave?
Yeah. Data in is data out, right? And the integrity of that data is sometimes questionable. But we try to survey our customers on the reason they moved.
Right.
And one fascinating thing that we measured for many months is the number of move outs after an ECRI, which if you remember existing customer rent increase, you're taking their rent from 80 to $100, whatever it is. How many people that saw an ECRI the prior month moved out? And then why did they move out? And we found that something like over 80% of our move outs that saw an ECRI did not move out because of the ECRI. They moved out because they no longer needed storage.
Mm.
So who knows if they're being accurate, on the survey, what percentage of our customers actually gave us responses on that. But we try both, verbally and through our technology platform, we try to understand if someone moves out, why, so we can better manage our revenue. But yeah, interestingly, that the vast majority of them apparently just didn't need the unit anymore. Maybe that ECRI was enough of a kind of a catalyst to get them. I was going to move out in 2 months, but now I'm going to move out this month. Maybe it costs us some revenue. But that was an interesting study. And our average duration of tenancy portfolio wide is something around 11 months, I think, last time I looked.
Mm-hmm.
So that's a long time to pay $100 a month, depending what you have in the unit, for sure. Yeah.
Yeah, definitely. So you've got these different funds right now, and you're also talking about doing single asset syndications or investments in the future. For those listening, can they invest in anything right now, or is it best to be on some type of list to see what kind of projects to come out with and keep on getting education from you?
Yeah. We've got our website, VanWestPartners.com. We keep our active offerings fairly up to date. People can reach out to us, Jacob at VanWest Partners, fill out our web form on the website. But as we have offerings come up, we'll start marketing them when they're fairly baked. We don't like to market deals that maybe there's some execution risk on still. We haven't gotten the survey back yet, or maybe we're concerned about an environmental report that we haven't gotten back. Yeah, the active offerings, as we do single asset deals, are deals that we get tied up. We believe in the business plan. We believe it's got a good risk adjusted return, and those offerings are available to investors.
Awesome. Okay, cool. I was curious in that. Kind of some rapid fire ones before we close out. I'm kind of curious. So, we started this today with talking a bit about, family and balancing things, being ruthlessly tactical with the calendar and blocking things out. And of course, as much time as you can with thinking strategically, that time that you have, those 15, 20 hour here and there kind of time. Do you have any, principles or things that you think of to, do you do quarterly planning? Do you do a monthly kind of, life review or stuff like that? How do you make sure you're on track where you actually, can balance between primary job, father, husband, and then real estate operator here?
Yeah, it's an evolution, right? And it's probably a never-ending goalpost you're trying to get to. As far as kind of like philosophically, it's best to talk about failures and not so much successes, right? I can remember the failures like they were yesterday, and you can fail on a deal, you can not hit a return you want, or whatever could happen. But one failure that I've had pretty consistently, probably the last year more specifically, is just inbox management. And I've got a business coach who's awesome. We've had him for like 5 years. And have you ever heard of Substack before?
Sure.
You probably heard of it. He got on Substack and he's doing some pretty good content. And one of the emails he sent out was the headline was "Want respect? Start responding." And it basically says like, delivered is not replied. Responsiveness is respect. Responsiveness is in kind. And I thought about that for a minute and went through my inbox, and not necessarily because I'm a POS, which maybe I am. There's a lot of emails that I miss. And what I'm trying to figure out is, all right, how can I have a, very, very high response rate? Even to some guy who's trying to cold call me or cold email me with a life insurance policy, that guy deserves a response. I'm not interested right now, and especially investors. It's the kiss of death. If you have an investor reach out to you, hey, what can you explain this distribution amount? And somehow you miss that. So responsiveness is my attempt to improve core value going into 2026, and I need to figure out the system and the process that's going to help me do that more efficiently. Maybe it's AI, maybe it's a VA, but just consistent, very high percentage, rapid responsiveness. That really kind of hit me between the eyes when he sent that email. Yeah.
Yeah. And I think that, I mean, prior to, and that probably, I can imagine that also resonated well because the obvious responsiveness always to your family, but also other places as well. Right.
Yes. To everybody, regardless of where they are in your social totem pole, a guy trying to sling a product to you that you don't want, or your wife's calling, right? Respond.
Oh yeah.
Yeah. Yeah.
Responsiveness is respect.
I'm not in a position to dispense any advice, but if one were to ask me, my advice would be take a risk. If you've been kind of sitting on the sidelines with some IRA money in your account or some cash, and you chop up deals, you talk to sponsors, you're never going to learn without taking risk. And there is no deal out there, no matter what somebody tells you, that lacks risk. But you'll learn by taking risk, and you take risk by deploying capital, buying a rental in your hometown, or dropping 50K in a syndication somewhere. And the greatest asset we all have is our time. And wealth creation in real estate takes time. And if you're not in the game, you're missing out on that upside. So take a risk in whatever form you feel like it's appropriate to take a risk. Invest in Steven's private credit deal, right? Downside protection, current pay, liquidity. That's what everybody wants right now. They don't care about IRR anymore. How much do I get quarterly? How do I get out if I need to? How do I not lose my money? Sign me up. People are a lot more excited these days about a current 9 with no upside that's quantifiable than they are an 18 that someday in 5 years, if you sell it at a 5.5 cap and you grow NOI 50%.
Yeah. They want cash flow now, right?
Yeah. Cash flow and downside protection and a visceral quantifiable return, not a someday IRR.
Right. Are you guys doing monthly or quarterly distributions?
Every once in a while, I think to myself, our investors have bills monthly. We should distribute monthly. It is enough of a knife fight and a goat rodeo to get our distributions out quarterly.
Yeah.
Maybe someday we'll do monthly, but we do quarterly, but it's like clockwork.
Cool.
It's 13 to 15 days by the end of the quarter. We initiate all our distributions out on the deals that are distributed.
Cool. And that is monthly, or that is the reports as well, investor reports on what's going on with the property quarterly as well.
Yeah, so we have a quarterly report that's very detailed on where we missed and where we maybe exceeded. We focused a lot more on the misses than we do on the wins. Sometimes the wins are just blind luck, right? Sometimes the failures are just bad luck, right? Sometimes we screwed up. So we do those quarterly, and there's kind of narrative in the body of the email, but also a very comprehensive PDF package. It's kind of color coded. NOI was light green. Expenses were red because we blew operating expenses. Physical occupancy, we thought we'd be at 82%. We came in at 79. And then in between our reporting cadence, we've got our Clear Insight software, which is that real-time dashboard into top-line performance metrics, occupancy, revenue, delinquency, tenant insurance, stuff like that.
Solid. Jacob, man, thanks for being here. All those links and the places to go and check out you and your team, as well as the investment opportunities, I'll make sure are in the show notes. Go check out Jacob's stuff. Go learn some more about self-storage, see where it fits for you. And I love what you said, Jacob. Only way to learn is to take a risk, deploy some capital, and keep asking questions, man.
Had a blast, and here's to improving fundamentals in 26. In 24, we used to say survive to 25.
Mm-hmm.
Here we are. It's almost over. It's not any easier than it was. Maybe it was harder in 25 than it was in 24. So now we got to come up with a 2026 rhyme for getting to 2027, right?
Yeah.
So let me know when you have any brilliant ideas.
Thanks, my friend. We'll see you.
Take care.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.